by April next year, the world will be in recession. You're going to see very much lower oil prices. Copper prices are going to fall to somewhere between 6,000 and 6,500.
But where do I hide out in the meanwhile? Because it's negative on everything.
I have a watching brief on uranium, and I will share your optimistic view. China and Russia will in some form link their currency to gold.
What does that mean, by the way, when a currency would be gold backed but not redeemable? Like gold would not be redeemable.
By early to mid 2025, world inflation will be around 15%.
But what kind of data or evidence are you using? Where are you finding that?
It's not until the early 2030s that crises bring about logic and common sense.
I've been hearing about sort of this everything crash, if you will, for a while now. But how's it going, everybody? My name is Antonio, and I'm back today for some macro talks with Simon Hunt, a man who's been in economics for almost twice as long as I've been on this planet for. And he's done more interviews than I've had hot dinners, so probably needs no introduction. But he currently runs his own strategic services business, which is a research service on the global economy, geopolitics, China, gold, copper, and stuff like that. A few other topics too. All of which, by the way, I'm planning on touching upon today, and maybe even throw some uranium into the mix for that, extra radioactive flavor, if you will. So that all said, Simon, thank you so much for investing your time in me, sir.
Well, thank you for having me.
Pleasure is mine, of course. And although I've watched many of your interviews over the last couple of days, and I feel like I know you already, and I kind of know what you're gonna say at some topics, but a lot has happened in the last 2 weeks too, the last 11 days or something like that. So why don't we kick it off with your assessment, if you will, of the current situation, of the troubles in the Middle East, and how that affects macroeconomics?
That is a huge question. The outcome is going to be very difficult to answer. There are so many moving parts. First of all, America is showing its full support for Israel. 2 out of their 6 aircraft carrier fleets will be off the Israeli shores. They've flown in their 101st Airborne Division from Romania into Jordan. There are rumors of 2,000 US troops going to be on the shores of Israel. Then you have an American airplane that collects samples of any nuclear activity flying up and down the Iranian coast. Why, I don't know, because there's no way that Iran is going to explode any nuclear facility, given the growing alliance with other Arab states and with Russia and China. So is it going to be a false flag operation, many of which we've seen before? Then, and quite clearly, the mood in Israel is to completely take out Gaza, reduce it to rubble, and then to attack the West Bank, and basically with the ultimate objective of making Israel an Israeli land from the south right up to the north. Whether that succeeds or not is a different question. What you're seeing now is Hezbollah doing some minor attacks on the northern front. What you're seeing also is the start of a bombing campaign against Damascus, hitting the 2 airports there. is this the start of something bigger that will force Russia to come to the defense of Syria? Does that then lead to a wider confrontation? The moving parts have such huge potential consequences. And if I had to sum it up, it's very simple, which is that what's under threat from BRICS is the end of the dollar hegemony and therefore the end of America's dominating role in the world. So if that is how Washington sees the future, how will they react? They're not going to sit back. So in my view, they will use every tool that they can to prevent BRICS finding an alternative to the dollar's fiat currency by producing a system that is based on savings and investment and not printing your way to the future. A 1970 dollar is now worth just 12 cents. So this is what BRICS Plus, which includes several oil-producing countries, are trying to achieve, which I think they will, unless first we get into war, which I think is quite possible, not now, but sometime in the next 2 to 3 years.
I'm sorry, I must have missed it, but how does that tie into the conflict specifically? Like, how's the one related to the other?
Because what's happening in Israel, if it draws in Russia, which then means that you are going to have a confrontation, a war between essentially the BRICS countries led by China and Russia versus America and other G7 countries. It's a continuation of the war over Ukraine. What was America's objective there? It was essentially, which it has been since probably the end of World War II, and certainly since 1990, has been to dismember Russia and thus able to control Russia's enormous natural resources. It's been their long-term objective. All that's happened is that the powers that control foreign policy in Washington have seen Ukraine as a first step to achieving that objective. Now, as they're seeing the war in Ukraine no longer going to be won by Ukraine, they're shifting the focus to create a second front of the war against Russia in Syria. That's how I see it, rightly or wrongly.
What do you? It's obviously an interesting topic and an important one, but what kind of data or evidence are you using? Where are you finding that? Because we are supposed to live in the information age, but there's just so much noise out there, and it's hard for me to sift through. So where are you getting all the data and evidence to base your decision on?
Various sources, which I can't really name. Certain blogs, which provide a lot of factual information, such as Colonel Douglas McGregor, Scott Ritter, Larry Johnson, just to name three, and others, personal friends.
Okay. You're also so what you were hinting at, and what you're a proponent, or at least you seem to expect, that some sort of a gold-backed currency will be formed and used by the BRICS countries, and let's call it BRICS Plus, because there's many more than just the BR on CS. But if that were to happen, what I'm thinking about is, wouldn't that slowly but surely hurt the US dollar to a point where there's no turning back? And so why I'm mentioning that is because I'm wondering how that will play out, given that the BRICS countries are heavily leveraged towards the US dollar, and they keep a not so small portion of their foreign reserves denominated in US dollars. If they move to a BRICS currency, wouldn't that hurt the US dollars and therefore hurt their own foreign reserves and hurt the country therefore?
I think there are going to be several steps before you get to a BRICS currency. The first step is utilizing local currencies in their inter-BRICS trade. For instance, the recent $1.5 billion worth of trade between UAE and India was all done in local currencies. Look what Argentina negotiated with the IMF. Payment will be in RMB. That tells you another thing, which is that every indebted country will have to increase their trade with China in order to get RMB to service their debt, which the IMF has agreed to. So the world is being drawn into two lots. The first is the G7, who will retain their fiat currency, which the BRICS Plus don't want to use, because what's it done? Over the years, they have accumulated a fiat currency in their reserves, which every year loses its value. So stage one, the development of local currencies. I think stage two is that China and Russia will in some form link their currency to gold. Both countries have got far larger gold reserves than are generally reported. China has probably, from what I pieced together, got over 50,000 tons of gold, about half of which is owned by Chinese households and institutions bought off the Shanghai Gold Exchange since its inception, which I think was 2006. So that's a lot of gold. And anecdotally, I can confirm that other institutions in China, other than the PBOC, own a hell of a lot of gold, which includes the PLA. And Russia has north of 12,000 tons. What's owned above the figure that the central bank owns, which I forget the actual number, something like 1,200 tons, is actually held by the company that oversees the central bank. So I think stage two, both countries will in some way or another link their currency to gold. And as a Chinese guy said recently, if push comes to shove, the government leans on its people and says, we need your gold. when push comes to shove, if that's necessary, because they own, in round numbers, 25,000 tons. So I don't think it's necessary for either currency to be convertible into gold, be backed by gold. And then I think the next stage is the creation of a BRICS currency, which is going to take time because it's a very complex issue. And I suspect that it will be based on the the currencies or the bond markets of the BRICS countries, and therefore indirectly, given China and Russia's dominance, indirectly linked to gold, but not directly. That's how I see it.
What does that mean, by the way, when a currency would be gold backed but not redeemable? Like gold would not be redeemable. What does that mean?
Again, the wording that one hears is pretty loose, but I think it is backed but not convertible. They have a link. My currency is backed by gold. This is what I have. But if you, America, wants to convert, we're not going to let you. But our currency is backed by gold. Your currency is not.
Okay, so it's kind of a gold linked
Yes,
currency, so it's not necessarily
correct.
backed. Okay, right. But so BRICS has existed for a while now, like over a decade, and they've always been sort of thought as the opposite of the G7, the opposite of the US, the opposite of whatever, the opposite of the West, sort of type of thing. But how long is this going to take? Your sort of 3-stage process. How long is each of those stages?
First of all, BRICS, the BRICS' bank, the New Development Bank, has only existed since, I think, 2015. It has its headquarters are in Pudong, Shanghai, where they own a complete building. From what I assessed from people who have worked there at vice presidential level and who've been involved in the development of BRICS since the start, i.e. Batista, Brazil's IMF representative on the board of the IMF, they encountered in the years up to just recently all sorts of problems and issues, partly bad management, partly sanctions, and partly because they're still using the dollar for most of their funding. I know, yeah, strange. But I think things are now changing. The ex-president of Brazil has taken over as the president of the New Development Bank. That's probably the first stage of the reform. But she can only be there for 2 years. But then Russia takes over the presidency, or they stipulate who will be the president, and that'll be a 5-year period. So I think BRICS will become, through the New Development Bank, a very powerful financial institution to rival the IMF and the World Bank. And I suspect that by the middle to late 2020s, it will be a very functioning financial institution.
What does that
For
mean, a
BRICS,
very functioning financial institution, more specifically?
it will rival the IMF and the World Bank
By 2025.
2025 to 2030, mid to late 2020s.
Okay.
But I think the big change happens in and or around 2025, when the world, well, what we see is, to give you our profile of what's going to happen. By the end of this year or early next year, America will be in recession. Those who dig below the published numbers actually say America is effectively in recession now. Europe is in recession in all but name. And if you look at the real supply, the real money supply numbers, things are only going to get worse. China's economy will slow until mid next year. So where does that leave you? Basically, by April next year, the world will be in recession, or most of it. You will also have the wars over Ukraine and the Middle East intensifying and broadening. The Fed and other G7 central banks will be forced to save their economies and save their bond markets. So interest rates sometime in the first quarter, sometime in the second quarter, will be falling sharply. The dollar will start falling sharply. And asset markets, having fallen by 30 to 40% between now and, say, April next year, will begin recovering. And with central banks dropping interest rates and flooding their systems with credit, you will have a huge recovery. Inflation starts taking off. And by early to mid 2025, world inflation will be around 15%. US bond yields will be around 15% as well. And that will crash the world economy. But you have what I call the last hurrah between mid-2024 and mid-2025, when asset prices basically double. And then you get the big collapse. So the big collapse, therefore, leads to what we call 7 years of rolling recessions, which will include conflicts within countries, almost civil wars, and wars between countries, i.e. China, Russia versus America and G7. It's not until the early 2030s that crises bring about logic and common sense between countries and leaders. And then we get into decades of peace, growth, stability. And for instance, GDP will return to the average that's been seen since 1900, of an average of 3.8% a year. And for copper, 4% a year, which has been the average growth rate from 1900 to 2022. But we have to go through the crisis first.
Thank you for a very comprehensive overview, sort of a year-by-year walkthrough there. What I'm wondering is I've been interviewing people since 2020 on macroeconomics and commodities, and I've been hearing about sort of this everything crash, if you will, for a while now. But since I pivoted to doing interviews, the S&P has almost doubled. The GDP is up over 10%. Unemployment is below 4%. CPI is below 4% too. Commodity prices are strong. PMI indicators seem to be bottoming, and so on and so forth. And you just said that people who dig beyond the gazetted numbers, if you will, something that I don't have the mental capacity for. What does that mean? Like, because what I'm seeing here is a recovery.
If you take the employment data,
sure,
it's all bunkum. It's created by the BLS. Look at the birth-death model. If you go to the real data, the real employment data, you've got employment falling, and every signal shows that unemployment will be rising. In fact, is rising now, and it will accelerate. As you say, if you go beneath the reported GDP numbers, doesn't look good.
But I feel like I've been hearing, or I've heard that a couple of times throughout the last couple of years, and I'm wondering why is this time different, or why has it taken that long for the capital markets to appreciate that reality, if you will?
But you're seeing it in the yield structure, 10-year yields. That's telling you the real story.
What's that telling us?
It's telling you you've got, first of all, that you've got geopolitical issues that are going to get worse, which means that funds flood into America over the next few months. But it tells you, I mean, for instance, we've got, if I can remember, the current 10-year yield is 4.6. We've got it yielding almost 5.5% by the end of this year. And then in early next year, up to 5.7. And then in the second quarter, they plummet to 3%. Why? Because recession, because the Fed and other G7 central banks are having to save their economies and to save their bond markets because of recession, because of wars intensifying. In other words, the markets they've not yet got to the stage of facing reality. They're still complacent. But the bond market has already sussed it out. The equity markets have not, but that's coming.
What happens at 5% interest rates or 5.5% 10-year yield?
We have equity markets correcting by about 30 to 40% by April next year, and meaning that the S&P will be around 3,000. Reality dawns then.
How come? Why? What's the significance there? That's what I'm trying to understand here.
Well, if you've got recession and you've got a war intensifying, the impact on households and corporates is going to be massive. So central banks have to defend, pushing the can down the road once more until you get the big crash. And again, that comes from your bond markets, your bond village vigilantes. They've finally woken up.
And what does that mean for? Because we're coming close to a Fed meeting on, what is it, November 1, I believe. Do they know that? I mean, I would assume them having the top economists out there, they would know what's coming, what's going to happen. And
I mean, I'm not going to speculate what they're going to do. Do they know? Maybe yes, maybe no. Do economists really? There are a few that do, but generally they don't see these things until after the event. Look at the IMF forecasts. They're always wrong. And you're supposed to have the top economists there.
Where does domestic liquidity come in? Which, by the way, domestic liquidity is now much lower than it was when the Fed started hiking rates and drawing down their balance sheet too. Where does domestic liquidity for the US come into play in your analysis here?
Well, the Fed will be pumping liquidity into the system sometime in the first quarter of next year.
Through
until then, liquidity is drying up.
Well, it seems like it's flattening out actually over the last couple of months, about a year almost.
But I suspect if you look at the real money supply, it's still shrinking.
When you say real money supply, do you mean the supply of dollars
money
globally or M2?
Deflated by taking inflation out of the numbers.
Okay. Because as far as I understand,
there's a guy in London that produces extremely good work called Simon Ward of Henderson's, produces a weekly, what does he call it? It's a weekly blog which is open to everybody.
Okay, yeah, and a newsletter of sorts. It's okay, but so that's U.S. liquidity. What about global liquidity?
Global liquidity is shrinking.
So do you expect that to keep shrinking?
I expect it to keep shrinking into the first quarter of next year.
Which is when you also expect the Fed to pivot.
That's when the Fed and other G7 central banks turn the taps full on.
Right. So is that what matters most, global liquidity and interest rates?
Yes, it's what drives everything. It's the best lead indicator.
Right. So they're going to pivot.
I mean, this is what, certainly in Europe, your copper and copper alloy fabricators are actually seeing. Business has not bottomed out. I mean, there's one fabricator that I had an email from a couple of days ago. Don't expect it until the middle of next year.
But the PMI indicators seem to be looking up. When I look at the PMI indicators,
I bet you that they will start going down again.
Okay.
That's what I think will happen.
That's I assume also something you look at, right? PMI indicators, or is that something that I don't?
Yeah, September, you've had a summer holiday and people come back, and very often you get a rebound in PMIs. But certainly the mood last week at the London Metal Exchange was anything but optimistic.
Did you go?
No, I didn't.
Oh, I went, and I went to a mining investment event, and it was also not lively, to put it mildly. But so when you talk about PMI, what are you talking about? Composite or manufacturing? Or I mean, because services PMI seems to be doing fine in China too.
Excuse me. The services PMI is starting to fall.
It's been robust though over while the manufacturing PMI was suffering.
It's been robust. People have been spending all the goodies that were given to them during COVID, but now those cash balances are being run down.
Well, again, so while the investment conference was rather empty in London, pubs were full. I passed by, everybody was spending money. Shops were full. There was lines everywhere.
How long does that last?
I want to ask you that.
Well, in my view, not much longer.
You're so used to.
I don't know what it is. It can be a catalyst, can be Banks, banks are tightening already. The catalyst can be what happens here in the Middle East or over Ukraine. There'll be a catalyst that actually wakes everybody up.
But you're not sure what it's going to be.
No.
What's on your bingo card? There's a banking crisis. What is it?
Well,
A full-blown war?
I think it's actually. I think the first catalyst is going to be internal within the financial markets. There'll be a failure somewhere. Look at what rates have done in 12 months.
Yeah.
The real pain of rising rates is not behind us, it's in front of us. It takes time for these things to work out. So I think it's going to be within the financial system, and the bond markets are going to be the lead indicator. You go from 4.6% currently to 5.4% or close to 5.5% by the end of the year. That's a huge move.
What would you equate it to? Just because this conversation is not being grim enough, what would you equate it to? Cancer or heart attack? Like, does it come to a stop immediately, or is it something that sort of drags on?
No, I think it's not a heart attack. It's a cancer type of process.
Okay.
You get the shock, and then you'll get the response is the central bank's response. And then you get what I call the last hurrah. And then finally, you get the death.
Right.
25, 26.
And that last hurrah would make sense to me. And when I see it, I will probably think it's a new cycle, being inexperienced and all that. Because, and where I'm coming from with this is because, again, market GDP, unemployment, everything seems to have held up rather nicely during a time of tightening and rising interest rates. So now you expect central banks to pivot. Well, when they pivot, wouldn't it be even better than now? Which right now doesn't seem too bad again.
Well, they're pivoting to save the economy and to save their bond market. What then happens is that by pivoting, you're going to get an acceleration of inflation, which will be compounded by oil prices probably rising to over $150 by early 2025 because of supply disruptions. And you will get food prices absolutely soaring because of weather patterns, in particular, the Glesberg cycle, which should come into being late this year, late 2024, early 2025. And this is an 89-year phenomenon. The last time it hit us, or hit the Midwest, it created the Dust Bowl decade of the Midwest. So you get a combination not just of sticky inflation caused by central banks throwing so much, flooding the system with liquidity since 2015 to an extent that it is trillions above the value of GDP. And then you get oil prices and food prices, and it's the food prices which really does the damage, because that's everybody. The lower income households will simply will have a problem surviving.
Well, I don't know if you heard, Simon, but according to Paul Krugman, we're no longer supposed to count those in inflation.
Well, Paul Krugman can say what he likes, but households have a completely different view.
Have you met Paul?
No.
Okay, I'm just wondering why he does it, because it takes a special sort of human being to say something like that, and I'm just wondering why. Like there has to be a why. It's not as simply explained by. I mean, what do they say? You know, you don't attribute to malice that which is simply explained by stupidity. But stupidity doesn't seem like a viable option to me. So I'm just wondering why he does it.
I can't answer the question because I don't know.
Yeah.
As you say, there must be a reason.
Right? Yeah.
Same. I mean, is it the reason to keep his fiat currency policy alive? I don't know.
Could be. Well, eventually they're going to give him a Nobel Prize for it, nonetheless. So Probably. It doesn't matter. But Simon, you used to travel to China a lot, and you actually used to spend about a third of the year in China before visiting
2 to 3
factories.
months.
But you've restricted your visits there over the last 5 years, but you still go there, if I'm not mistaken. Talk to me about the situation there on the ground. Like, how is it different now than it was 5 years ago?
First of all, my last trip to China was just before COVID in November 2019. But I have many friends in China, and I talk virtually every day to them. So my view is this. The government has made a decision that it is going to allow the chips to fall as they may, and when the chips do fall, they will then isolate those chips, whether it be real estate developers bankrupting, or whether it be the risks of default of local governments. Those are the two big risks. So basically what their conclusion is that for many reasons they will allow the real estate developers to collapse, but they will support the households. For local governments, they will not allow local governments to default. They will give them bonds in which to finance infrastructure projects. The latter will be a 2024 story. The second policy initiative is that you have in China something like 362 households whose annual income is lower than the national average. So incentives will be given to allow those households to increase their incomes. So their future growth is going to be based, future domestic growth, I come on to external in a minute. Domestic growth will be based on far less on infrastructure, far less on real estate, which will remain a drag on economic activity for several years, but on the growth of the income of these 362 households, plus technological companies. It's very interesting that Huawei developed its new chip that has the power of a 7mm chip, completely outside what Washington felt that China could do. What people forget is that China also has many of TSMC's suppliers are based in China. So the technological know-how in China is actually very large. They've committed something like $30 billion to the semiconductor sector. So this is going to be a big growth market. Then if you look around what they're doing, low value added companies are exiting China, going to Vietnam, Thailand, Mexico, etc. But what you're seeing is growth of high value added companies. China is now the largest car exporter. It's also the largest battery exporter. It's the largest solar panel exporter. And what you're also seeing, they've taken a very pragmatic view in contrast to the West, on climate change. There is this, of course, this big focus on wind and solar, but at the same time, they're being extremely pragmatic and building massive new coal power stations. So and then on the export side, there's no longer a focus on exports to America and to Europe. The focus is on BRI and BRICS, where, and I've forgotten the numbers, but you're seeing a massive increase in exports to those two groups of countries. So China is in a transition period. People talk about, look at your debt structure, but nobody talks about what is the net worth of central government. There's an IMF paper drawn on 2019 data, or it might have been 2017 data, which shows that central government has a net worth of $140 trillion. So look at the excessive debts that local governments have. It's very easily assimilated within the banking system. There's no problem at all there. So China, if I look at China over the next 10 years, yes, growth will slow, probably to around 4.5%. But that's going to be double G7 countries. So when you look at stock markets, we have stock markets falling, as I've told you, by about 30 to 40% by April next year. We have Shanghai stock market only falling by about 10%. So what you are in effect seeing is that G7 countries are exiting China. The Chinese are buying China. Voila.
That's an answer. But in conclusion, for people who kind of like me have 4 brain cells to work with, is there you're not bearish on China, and you think they're going to be taking their number 1 spot soon enough, and you think they're going to be much better off over the next?
I think they because for at least 2 years they have recognized the oncoming fragility of the West, economically and financially. And they have been preparing for the crash or big correction in global markets. They have, that's why that they've not had a big stimulus policy during COVID or post period of COVID, just done enough to put a cushion under the economy. That's all. Stability has been their policy, not stimulation.
Right. There is a
So
fiscal.
basically, what they've been saying to the local governments, you've got to live within your means. And in providing local governments with the means of getting out of their debt situation, they're taking control over their budgets. So the power is coming back into Beijing and away from the local governments.
Does that mean fiscal deficit this year?
Not well, the deficit, they've set the fiscal deficit at 3% this year. I don't think they're going to increase it. I think they will increase it next year. There's all this talk about big new policy to stimulate the economy before the end of the year. I think that's nonsense.
So no special sovereign bond issuance.
Yeah. If they were going to do it, they would have done it after the August seaside retreat. It's out of character to do it so late in the year. It's next year's story.
Okay. So next year, kind of like in 2020, right? Because 2020 saw that extra bit of fiscal deficit with the special sovereign bond issuance, right?
Yeah, I think China's economy rebounds very strongly next year.
Okay. Well, that's not the consensus you get from sort of reading the news. It's been, it's been China's going to crash and burn. There's CEOs falling out of hospital windows and
I take very little notice of consensus views.
No, I've noticed.
As you probably gathered.
I've noticed, yeah, for sure. It's you don't particularly have the rosiest of views out there in terms of macro either. And so I try to talk to people who have opposing views as much as possible, get exposed to as much information as possible. And I hear different opinions too. But what would it take for you to switch over to the opposing view and change your mind? What's something you'd like to see in the global economy or geopolitics that will make you positive on the West, or is it unsavable from this point on?
I think that you can't get out of what the central banks have sewn themselves into. You cannot have debt growing faster than GDP forever. And that's what's happening. What would make me change my mind if all the Western countries' government policies, fiscal and monetary, went back to basics. We cannot have debt rising faster than GDP, which means that we've got to take a sharp recession in order to get there. Then I will get positive, but I don't see it coming.
So it's, a solution to that might be what Buffett said, right? That he can end the deficit in 5 minutes.
Sorry, say it again.
I was saying that a solution here might be what Buffett was saying, that he can end the deficit in 5 minutes and he can solve pretty much everything in 5 minutes.
Yeah. But you got to take the medicine.
It's true.
And the governments are not prepared to take the medicine. The medicine has to come out of their hands. And the bond markets will create that medicine.
Most, if not all, of your early career and still now, your career now was focused and is focused, built really around copper. Is this what copper is telling you right now? Because they say copper often, Dr. Copper forward-looking indicator and so on. Is this what Dr. Copper is telling you right now as well?
First of all, I think Dr. Copper used to be the doctor of the economy, but it's been so influenced by financial institutions and the algos that I don't think it has the same doctorate that it used to have. But what I do think is going to happen is that copper prices just below 8,000 now are going to fall to somewhere between $6,000 and $6,500 by April next year, because you've got demand destruction of physical copper. And with a large correction in equity markets, the bulls who still exist, though they seem to be quietly unraveling their bullish stance, will have to throw in the towel. So you're going to get, by April next year, a price of around 6,500. But then as the central banks drop rates and flush the system with liquidity again, you're going to see a recovery in business. And as inflation begins to take off and the dollar falls sharply, then you'll find a repeat of what we saw between the summer of 1979 and 1980, when copper prices rose by 75%. Similar circumstances. But I think the increase is going to be sharper than that. The world has changed. I mean, to give you one example of what happened in that period, which will repeat itself, I'm sure, in this coming period, is that I then had a client who was a major American chemical company who told me after the event that their hedge against inflation and the dollar falling was to buy 200,000 tons of physical copper. And today, that's something like 500,000 tons. So what we're going to see is a big difference between physical consumption and physical demand. Physical consumption should be something like 25.3 million tons next year. But demand will be 26 million or higher. So you will have massive deficits, big increases in prices. I've said more than doubling between the low point and by mid-2025, if not early 2025. Go back to 1979, 1980. Similar circumstances. Then after that, you've had your hurrah. We get massive collapses of asset values across the world.
Do you use something like the gold to copper ratio to figure out?
I don't, but I do have a view on gold, which I follow gold carefully. The trends, not the day-to-day movements.
What does that mean, the trends and not the day-to-day movements?
Well, I'm not a trader. I'm a strategist. So I would say you'll see gold taking off probably in the second quarter of next year. Where do I see gold going? At least 2,500, probably higher, but I can safely say 2,500 by the end of 2020, by the end of 2024.
That's while copper is falling.
Yeah. No, by the end of 2024, copper's rising.
So they're going to be rising.
The fall in copper is first quarter of next year.
Okay.
Then you start seeing the recovery.
Right. Do you share the same opinion on oil, for example? We talked extensively about bricks, and what do we have now? I believe.
Yeah, I I think that by April next year, you're going to see very much lower oil prices. But then you're going to have the huge takeoff.
Why? Why do you think prices are going to be lower? I mean, there seems to be a supply squeeze going on right now. So why would they fall?
Well, I think one reason is the American government doesn't want to see rising oil prices at the moment in front of an election. So I think that whatever they do.
What can they do?
Well, through the hidden budget funds, they continue to sell it through derivative markets.
But the SPR is already low.
Yeah. But they can sell through the financial markets, and also you're going to see demand falling sharply as the world goes into recession. It's going to hit oil demand as much as copper.
Sure. Is that true?
It'll be in the first quarter of next year, it'll be a buying opportunity.
Okay. I'll be watching out for that, because again, oil is also kept up nicely, and it seems like the Saudis are determined to keep the production cuts.
I know all of that, but I think there are other forces at work.
Okay, that's not something like it seems. It's hard because those things that you're mentioning here is not something I can see or double check. It's sort of a wait and see type of thing.
Well, I think the recession call is already in place.
But based on what kind of, again, going back to the data question,
based on you just look at real money supply, you look at the PMIs, you look at what people who physically use materials like the chemical industry or the copper industry. Business is falling.
Is that so? But that'll basically be the same, like, because the same logic applies to other commodities as well, specifically the industrials. They would probably follow. I assume you would believe that they would follow the same path as copper and oil.
Yeah. All the metals will. Yeah, sure.
Right. And so this is where at the beginning I mentioned I'm going to bring up uranium. Uranium doesn't seem to play by the same rules because of its inelasticity. Do you have a view there? Have you looked into uranium?
I have a watching brief on uranium, and I will share your optimistic view. Where is the future energy going to come from? It's not going to be from solar or wind. Far too many problems. It's going to be a reversion back to fossil fuels, hydro, and uranium.
Did you participate in the last uranium bull run?
In
2007?
No, I participated in the one before that.
What do you remember from then? How are things different?
Then it was a supply-demand deficit issue. And it's going to be the same this time, except for even made worse.
True. No, I agree there. Well, I think we've been through like literally everything. We've been through stocks. They tell me about the S&P. We've been through bonds, which it seems like bond bulls just cannot catch a break. There's people being bullish on bonds since 2020, and they're just constant pain. And you think that there's more pain ahead for them because you expect the yields to be rising. So interesting. Okay, but where do I hide out in the meanwhile? Because it's negative on everything. Where do I hide out?
Well, if you're in the market, you take profits and wait to come back into the market sometime around the April-May period. But don't stay on the dance floor until the end of the music.
You think the beer bottle has already hit the wall?
It will be a 12, 18 month bull market, and then that's it.
Okay. But okay. So you're basically saying that again, the beer bottle has already hit the wall.
No.
Well, the first. Okay.
It's a process, and we're at the beginning of the process.
At the beginning of it. Okay.
Yeah.
Sure. This is going to be very interesting to follow up. You've given me a very, very broad overview. I've been taking as many notes as I could for myself possibly could. So it's been interesting. I want to roll the die here. I want to roll a D20, which is going to give me a number, and I'm going to do it 3 times. So it's going to give me 3 numbers, and those numbers are going to correspond with one of 20 questions that I have on my list. And you can talk to me about that. Is that something you're willing to do?
So you give me some numbers and I call out one and you give me a question. Is that it?
I am basically going to roll a die on here on my computer. I'm going to do it right now. And that number is 17. So I'm going to go to question number 17 on my list.
Okay.
And then let's just scroll to question 17 is going to be probably a very, very fitting question for this conversation. I'm going to be 30 by the time you said that things are going to start getting better. So what advice would you give your 30-year-old self?
Work hard and enjoy life.
So work hard, play hard. Sounds like good advice to me.
Work hard, play hard.
And I'm going to roll
and remain active in sport.
Well, that's a very good point.
Well, I play tennis with a top pro here 4 times a week.
Nice.
And on Tuesday, the humidity was 70 and the temperature was 30.
Wow.
Plus. And on Friday, the humidity was 90 and the temperature was in the mid-30s. And we survived.
And this is in Dubai.
Dubai,
yeah. Okay. Interesting place for sure. The next question that the dice are giving me here is gut feeling versus analysis paralysis. Both are negative, but if you had to choose one, where would you lean to? But I find myself...
I think it's important you do the analysis. But when you come to the conclusion, you have to follow your gut.
That's a good point. But what if you're
inexperienced? You got to do the analysis first.
It's analysis first and then follow your gut. It's kind of tough for me because, again, I'm not particularly intelligent and I'm by far not experienced. So following my gut sounds like tricky advice.
You have to do the analysis first.
You do the analysis first. Okay. The next number that I have on here is number 10. And the 10th question says, are you... I'm going to change it a little bit because I don't know your portfolio that way. But how do you feel about exploration and development companies? We talked about natural resources, uranium, copper. Do you look at them as lottery tickets and you stay away from them? or do you think there's real value to be found in them right now?
Well, as I'm a director of a copper exploration company and a director of a gold exploration company, I obviously have to say I have value in them.
You have to say that because you have the position.
No, I believe, well, I believe in those two companies. It depends on which company.
So you're going back to do the analysis
It's
first.
not just the potential of the ground they're exploring, it's also the management that they have.
Right. What else? The geological potential management. What else do you look at?
Well, that's basically it, isn't it?
Well, I don't know. There's jurisdiction and all the rest.
Location is important.
Right. Yeah. Okay. So we've gone through literally everything that I could think of, and it was a very, very good conversation. Is there anything that you came here hoping to talk about, but I'm failing to bring up?
I think your questionings has really exhausted what I know.
I doubt it. I doubt we've even scratched the surface, but I'd be happy to go back to these things and review them in a couple of months' time.
Yeah.
In the meanwhile, if I want to stay up to date with your information, what do I do? Where do I go?
Yeah. The website is simon-hunt.com.
Simon-hunt.com. That's where your strategic services, as you call them, are.
That's where you can find the information and our bi-monthly newsletter.
How much is that, the monthly newsletter?
$120 a year.
Okay. What do I get from that? Oh, that's a year. So it's $10 a month.
Yeah.
So it's like, so instead of Netflix, you can do this.
Yeah.
You should do this, in your opinion, I assume. So what do I get for that $10?
What you get is our overall views.
Okay. And that's you and your team.
Both that's views on the global economy, geopolitics, and the copper industry.
Okay. Right. I see it on here. It's 2 newsletters per month. Members access to newsletter catalogs. Oh, so you can go back to newsletters too.
Yeah.
Okay. Got it. Awesome. Simon, this has been great. Thank you so much for investing your time with me, sir.
Pleasure. Thank you for having me.